This is the revision of Advanced Audit and Assurance, and this is the question 3, Part A, Evaluation of Subsequent Events and Final Analytical Procedures. Okay. Analytical procedures are performed as an overall review of the financial statement at the end of the audit to assess whether they are consistent with the auditor's understanding of the entity. Subsequent events procedures ensure that the sufficient and appropriate evidence in relation to events occurring up to the date of the auditor's report are appropriately reflected in the financial statements. Part of the final review process will include a review of results of audit procedures to ensure that they support the findings and overall conclusions which have been drawn by the audit team. Inventory. The move to just-in-time inventory system is consistent with a fall in the inventory levels and inventory holding periods. Evidence to corroborate the year-end inventory balance has been primarily provided in the form of inventory count attendance, for which no issues were identified. The extent of work performed at the inventory count is unclear from the documentation provided, and it would be unusual that no further work was required on the existence and completeness of year-end inventory beyond inventory count attendance. It would be expected that the auditors perform a reconciliation of inventory count data to the detailed analysis of the year-end inventory report during the audit to ensure that the report is accurately reflecting the inventory count data. It would also be expected that the accuracy of the cost of the inventory is tested with reference to purchase invoice and overhead absorption calculation for work in progress and finished goods on hand. As such, the evidence referred to in the final analytical procedures is insufficient to be able to conclude on the existence, completeness, and accuracy of the inventory amounts held. The increase in the write-off for obsolete inventories as a percentage of the inventory held is more unexpected, even though this will still mean a smaller total amount of obsolete inventory held than in the previous year. It would not be expected that a higher obsolescence rate would be seen under just-in-time system, as theoretically inventory is only ordered to satisfy specific demand. As such, more evidence needs to be obtained in this regard, particularly as estimates such as these are susceptible to management manipulation and may be used to manipulate the profit of the company. Further discussion with management and production staff are needed to identify how these figures has been derived. This may be the case that the amount relates to specific items which should have already been written off. For example, if those goods are for the specific cancel order. It could also be the case that this figure is based on the general percentage amount of inventory held at the end. An inventory should be assessed on a line-by-line basis rather than as a general adjustment. The auditor would need to determine whether this would result in material misstatement. The comment that the current allowance for obsolete inventory is immaterial and therefore no further work has been performed is inappropriate. A misstatement in this allowance could be material in conjunction with other misstatements, and at present, there is no evidence as to whether this value is under or overstated. As such, the auditor should obtain the detail of how the allowance has been calculated and assess the appropriateness of the assumption and method used by R&Co. The auditor should review slow-moving items and perform further net realizable value testing to ensure that any slow-moving lines of inventory have a sale value in excess of their cost or are written down if appropriate. Trade receivables. The increase in receivables collection period compared with the prior year appears to suggest trade receivable may be overstated due to an understatement of the allowance for irrecoverable trade receivables. The audit team has relied on direct confirmation from trade receivables as evidence of recoverability, and this is inappropriate. While direct confirmation of balance can provide evidence of the existence and accuracy of balance, it does not provide sufficient evidence of recoverability and therefore the valuation of trade receivables. The auditor should have performed up-to-date testing to ensure that year-end balance have in fact been settled post-year-end. In addition, the results of the subsequent events procedures contradict the assertion of the credit controller that chemical will settle their outstanding balance. The subsequent event identified for R&Co has been identified after the date of the financial statement, but prior to the issue of auditor's report. Procedure must therefore be performed to corroborate the accuracy of the newspaper story to establish whether there is an impact on the financial statements requiring judgment or disclosure, given the late payments made by Chemical to R&Co during the year ended 31st March 2025, the fact that Chemical has entered liquidation so soon after the financial year end. It is likely this will be classed as an adjusting event under IAS 10 event after reporting report, providing evidence of conditions existing at the end of the reporting period. As such, management should be asked to write up any amounts which will be irrecoverable as a result of Chemical entering liquidation. An inventory order specifically for Chemical should also be assessed to ensure it can be sold to other customers. As with the inventory, it is inappropriate to conclude that no further work is required because the reduction in the allowance is not material. It is possible that the allowance could be materially understated and further procedures should have been performed to confirm this is not the case. Regarding Banabico uncorrected misstatements and impact on audit opinions. During the completion stage of the audit, the effect of uncorrected misstatements must be evaluated by the auditors, as required by ISA 450. Evaluation of misstatement identified during the audit. This requires that the auditor obtain understanding of management reason for not making recommended adjustments to the financial statements, and that they take this into account when evaluating whether the financial statement as a whole are free from material misstatements. In order to maintain accurate accounting records, management should be encouraged to adjust for all misstatements to ensure the risk of material misstatements in future periods is reduced due to the cumulative effort of immaterial uncorrected misstatements. ISA 450 also requires that the auditor communicates with those charged with governance about uncorrected misstatements and the effect which they individually or in aggregate may have on the opinion in the auditor's report. Both matters included in the schedule of uncorrected misstatement will be discussed below, and the impact on the auditor's opinion considered individually. Government grant. In accordance with IAS 20 Accounting for Government Grants and Disclosure of Government Assistance, grants relating to assets may be presented in one of two ways, either as deferred income or by deducting the grant from the assets carrying amount. The grant is then released to the statement of profit or loss in line with the use of the assets, either as a release of the deferred income or through a lower depreciation charge arising where the asset cost has been reduced by the value of the grant. The recognition of grant in the profit for the year is incorrect as the asset has not yet been purchased. The grant amount of $5 million should have been recognized as deferred income at the reporting date. As a result, profit is overstated and liability are understated, as the grant represents 11.6% of profit before tax and 4.8% of total assets. This is material. This therefore represents a factual material misstatement, and management should be asked to amend the financial statement. If management does not amend the financial statement with respect to the government grant, then the auditor also will issue a qualified opinion on the basis of material misstatement. As a misstatement is confined to two specific elements and does not represent a substantial portion of the financial statements, this would not be considered pervasive. A basis for qualified opinion paragraph would follow the qualified audit opinion, which described the matter giving rise to the qualification, along with the quantification of the financial effects arising. Machine sales. IFRS 9 financial instrument requires receivables such as that arising on sales of machine to be recognized initially at fair value and held on an amortized cost basis. The fair value of the receivable in this case is the amount due in 1 year discounted back to the reporting date. Management recording the transaction at cash settlement value will result in an overstatement of receivables and an overstatement of profit on the disposal of the machine. The amount of the overstatement is $1 million. This presents just under 1% of assets and 2.3% of the profit before tax, and therefore is unlikely to be considered material in isolation. Management should be requested to make an adjustment for the misstatement Even though it will not be material in its own, the adjustment will reduce the risk of cumulative uncorrected misstatements in future periods. As a misstatement is not material, it will have no individual impact on the auditor's opinion.